Hello. So Adobe is a stock that I've been trying to snipe for a while now, and it reported earnings. After its report, which actually was a beat, you will see that the stock is actually up about 5.3% right now, as the markets have already opened in the US. Now we're going to be taking a little bit of a closer look at the financials and what happened with Adobe, and see whether this kind of price that we're having now is an interesting potential buy price. Now let's take a little bit of a look at what happened at the earnings report. You will see here that Adobe beat on the top and bottom lines. That is revenue and net income. That's what it means, and beat on guidance as well. So pretty wholehearted beats here. And we're gonna see the details. The fact that the sales were up strongly despite foreign currency headwinds is also an interesting thing. Now, what happened here? The stock has ticked up a solid 5% right now, as you saw. On Thursday morning, after the company reported earnings that beat on top and bottom lines. Now, analysts had expected the company to report only $3.62 a share, and they reported $3.8 a share. And the sales were 4.66 billion, so a little bit more than expected here. And they also beat on guidance as well. And it's interesting to see, again, because the sales rising 9% despite the currency exchange headwinds is a pretty interesting thing here, and pretty important for investors to see that the company is doing well despite what has been happening with the currency lately in the US and the whole world pretty much. Now, while investors are cheering the earnings beat and management's guidance for roughly $11 a share in GAAP profits for 2023, there are some reasons to be suspicious of Adobe, is what the article says here. Consider if Adobe hits its earnings target this year, 11 cents a share divided by the share price is an earnings ratio, P ratio of 31.5. So the article is kind of telling us that it's a little bit too much to pay for a company that is not growing that much right now. And you will see here that our tool is also pointing the same thing here, pointing at the same thing. The fact that the P ratio right now is pretty expensive. And you will see that it has been getting better because the stock has been super overpriced for a long while. And you'll see the correction here. So this used to be almost $700 and pretty much going down and down and down and down. And at some point it was even much less, actually. You can take a look at the 1 year chart here, for instance, you see it was $285. And at some point even here, $275. Not less than that, but still, when you take a look at this over here, it has been $687, for example. So it's much less than what it used to be, almost half that price, but still looks a little bit expensive. Now, in terms of the free cash flow ratio, is a little bit better here after the adjustments, and the company has been buying back some shares. So it's not like they're issuing more; they're basically buying some back. Now, one of the things that I really like about Adobe is their model. It's a subscription model, and also the things that they are selling, the software that they are selling, is almost a monopoly, or I should say maybe an oligopoly. It's tough to emulate, and it's not easy to get too many competitors. It's not easy to get competition for this kind of business, is the thing. And that's so obviously something that I would really like as an investor. Now, of course, it has to be cheap enough, right? And the company also doesn't have many liabilities compared to the free cash flow that they generate over here. And you will see that they are still growing nicely, rather nicely. It's not a super growing company, but they are still growing fairly well. And the net income is pretty nice here. The free cash flow, same thing. And the equity is also going up without the company pretty much issuing new stock. And the other thing that you love to see, of course, is the margins, because this is obviously a software company. The margins are super high, although a little bit suppressed from what they used to be, but still pretty high, close to 30% right now. And obviously this actually reflects itself in the returns on equity, for instance. Now, what about the financial statements? Let's take a little bit of a look at the exact numbers, like 9 billion, 11 billion, 12, almost 13, 16, 17.6. So it's growing, and it's in some years at a pretty nice rate. Lately, it has been growing at 11%, and I think analysts are expecting a little bit less even. But still, it is growing nicely. From 9 to 17, it's not bad at all in 5 years, 5 fiscal years. And in terms of the net income, 2.5 billion to 4.7, almost doubling it. Very nice to see. Although at some point it was even higher, so there has been a little bit of suppression lately. Again, kind of understandable. In the most recent time, the market has been a little bit weird. And also this has been reflected at the price as well, at the price of the stock. Total equity from 9.3 billion to 14 over here, with the company pretty much paying some money to buy back shares. So that's nice to see. In terms of the cash flow statement, again, remember we're starting with a net income over here, and we adjust for non-cash expenses like stock-based compensation, depreciation, amortization, taxes, change in working capital. And so after all these adjustments, we are getting operating cash flow of $7.8 billion with very little capital expenditures, less than $500 million here, as you'll see. And in terms of the financing activities, minus 6.8, pretty much meaning that the company is repurchasing stock. As you'll see here, they are spending money to repurchase stock pretty much year after year. And the free cash flow from 3.7 billion to 7.4, a pretty nice increase over here, very nice increase. But what about the price of the stock? Because obviously this is the most important thing. Like, we love the business, we really like the business here, we like what they are doing with their earnings and what they are reporting. But is it a buy at the current price is what we should be asking ourselves. Now you'll see the little table here, the handy table that we have is almost green everywhere, apart from the last couple of years of net income, basically. But the revenue growth that the company has been achieving has been at a rate of about, as you'll see here, the 5 years, about 20%, which is very high. Although recently, again, as I mentioned, it has been going down. So it's not like we're expecting this kind of flow to continue. It used to be like the previous 5 years where like you can kind of see it here, 23%, 23% over here. This year was also a pretty nice year, but it has been dropped by, for instance, the last fiscal year. So we have to be a little bit careful here and go a little bit lower. Let's just try 5, 8, and 11 here for our revenue growth in the next 5 years. And the net income margins that we're going to use are going to be somewhere in the range of 30%. So I'm going to go 28, 30, and 32 for the good scenario. And the free cash flow margin that I'm going to use typically it seems to be higher than 100% here for the company. I'm going to go 100, 105, and 110, and an annual return of about 13% here. Now I hit calculate, and we're getting what I would expect it to give us, basically something that's around the range of $200. Probably would make sense for this company. Now, obviously, again, this is a company that has a lot of value, and so I would be willing to pay a little bit more than what the discounted cash flow model tells me, because again, there are some nice things about the company. The fact that, as I mentioned earlier, it's almost an oligopoly. It's having great margins, so it has been growing nicely over the years, and they have a very healthy subscription model that people are unlikely to unsubscribe from, or at least the majority. And so, even if the medium one is sitting at about $220. I would definitely consider spending somewhere around that range, even $250 maybe in some situations, because I recognize the value of the company. As it is right now, $351, it's pretty expensive, and so it would have to go a little bit lower, if not significantly lower, maybe $100 lower or so, for me to make sense to potentially add this to my portfolio. Although, I kind of understand people who are potentially willing to add this one to a portfolio. It seems to be a little bit more expensive than what I would like it to be, and there are probably better opportunities right now, cheaper I should say, if not better, because this one is a good opportunity, but in terms of the price, it's a little expensive is the problem. The company is great. It has fallen off a cliff, again, in terms of its stock price for sure. But I think that, again, for this kind of money, for this extra that you're paying, you can probably get even better deals in this current market. And so I would avoid buying this one right now. Maybe wait on it to see if it goes below 250 or something of that sort. Then it would become really interesting to me. But thanks for watching, and I'll see you in the next video. In the meantime, take a look at this one that I made earlier, and I'm discussing Meta in this one just to see whether it's a buy right now, as it has been flying recently. Again, thank you for watching. I'll see you soon. Bye-bye.